Hey everyone, me Kevin here. In this video, I want to go through some of my first impressions on 23andMe and their Virgin Galactic SPAC, VGAC. Is it worth investing in? What valuation are you investing in? Why is it down 8% today? What's the story here? Well, let's get right into it. First, I think it's helpful that if you don't know what 23andMe is yet, let me give you a very quick and basic primer using myself as an example as a customer of 23andMe. Basically, you spit into a test tube and they run your DNA. And over time, that DNA becomes more and more, or the conclusions from that DNA becomes more and more accurate. See, when I first used 23andMe, I was considered maybe at most 67 or 69% German. It was something like that. And over time, as more people use Ancestry DNA or 23andMe or all these DNA websites, whatever, which you're giving all your data to, basically. You gave them your whole genetic code, right? Although your doctors probably already got to that first, but who knows? We're not going to get conspiratorial here. But what's cool is, over time, that data becomes more and more accurate as more and more people use it, because they're able to put more of the puzzle pieces of your DNA linkages together. It's like, oh, here's a marker from the year 200. Oh, we keep seeing that year 200 marker come up in people who used to live here. And that's how they're able to more narrow down that map, because once you have a marker on your genetic code, it stays there, which is really cool for seeing sort of your family tree expand. It's basically like the puzzle pieces are there. We just have to find them all to put it all together. And then that's kind of what 23andMe is doing. And by doing this, they're able to potentially help people identify their risks for certain cancers or their risks for, activity or allergies or whatever. It gets better and better over time. They Q&A people. There's so many things you can do in this. See your next reports, sleep movement, asparagus odor detection, cilantro taste aversion, I don't know, all a fear of heights. I mean, they survey people on all this crazy stuff, and you could spend a ton of time in here trying to learn about what you're most likely going to be affected by versus not affected by. But anyway, what I want to show you is, remember how I said my Ancestry report used to say like 69% in German? Now, if I go into my Ancestry, you can actually see now 89.9% French and German, up to, well, now 99.9% European. I actually used to have 0.01 Jewish. It was like they had a little bit of Israel in there, and that went away in the latest update. And now it's just literally just solely putting me up here in this sort of French and German area. But what's interesting, when I click on French and German, now it actually narrows it down even more. Like there's not even any blue region in France. It's literally just these different areas in Germany here. And it's sort of interesting because I was, if I zoom in, I don't think I could zoom into Germany anymore. Oh, I can, look at that. I was actually born in this region right here, North Rhine-Westphalen. Anyway, yeah, so, okay, cool. So the app gets better over time. I get it, cool. Do we want to invest in the company? Well, that's the big question. So we got a slide deck. I'm not going to go through, look, I hate slide decks because slide decks are like just pure marketing to try to brainwash you to invest in the company. We're just going to mostly look at the bottom lines here to determine, does it make sense for you to invest in this company, and sort of my opinions on this. So, okay, so investor presentation, basically they're thinking of merging with VGAC, but mergers can fail. It's a SPAC. I think they say like 80 to 80% of mergers actually happen with these SPACs once they're announced. This is a big data play, right? The more they can actually get people's DNA, the more they can sell your crap. They give you cool charts and graphs, and you just sold your life's worth of data, essentially, at least in DNA. I don't want to sound depressing, but this is a big data play, and they're basically telling you, hey, we haven't really figured out how to monetize this yet, but we're sure we will in the future. That's the goal. And they go, hey, look at all these customers we have. We have 10.7 million customers. I don't really know why they're comparing us to Regeneron, but they are. So, then they complain about the healthcare industries. This is kind of cool. This is worth looking at. I just highlighted the parts that I think are worth looking at. These are some things where they're able to now, with 99% accuracy, determine your risk factor for things like breast and ovarian cancer, colorectal cancer. I mean, these are nice things to have a heads up on, It could increase your likelihood of wanting to get screened or maybe taking preventative action. There's some cool benefits to actually doing the service. And I'm not sponsored by them. I don't have an affiliate link down below. I'm just looking at this solely as an investor here. They do like ancestry, like relative trees here. Maybe you can find relatives you didn't even know you had. I've only found like a 4th generation connection through the tree, never even reached out to them or anything yet. But I, a few years ago when I took this, actually like 6 years ago when I took the test, I didn't have any connections. So it's interesting. It does grow over time. So like if you take one of those tests, you do you do kind of like it's sort of this renewing subscription that you don't have to keep paying for, which is great. But anyway, okay, it helps people take positive action after having their genetic data, or it gives you increased likelihoods for atrial fibrillation or whatever other things in here in the slide deck. Cool, big consumer demand. Keep in mind that this particular company went like viral in 2017 and 18, and this is going to be a problem when it comes to our sales data, which we'll look at in just a moment. But you can look this slide deck up too if you want to look at this in more detail. Just Google 23andMe slide deck. But I want to get to the parts that matter. So we're going to quit flopping around here, and let's get to the parts that matter and make some conclusions here. So here's the thing. 23andMe financials. Little bit concerning, obviously, that when we look at their revenue here, we've got this decline in revenue, right? We've got a decline here from 2019 to 2020. We've got a decline to 2021. We've got a decline. So we've really got this declining revenue, maybe potentially after that viral wave that we saw in 2017, to now this potential forecast for increasing revenues. The problem with these slide decks is you always have to remember forecasts are forecasts. And of course, if they're going to be selling a SPAC, they're going to be excited about their forecasts. I get nervous about forecasts. I like actual data and actual sales. And I have to say, over the last 3 years, their website data, it leaves something to be desired. Here's their, we're still on this. Hold on one sec. Let's grab this here. We're going to jump on over to look at the analytics for 23andMe. And generally, when I like investing in a company like Etsy or Pinterest, I like seeing, straight up growth. That's what I want, is basically nothing but a growth. Well, at 23andMe, we've got, a little bit of that decline still. And again, this could be from that virality that we saw in 2017 to 2019. But the trend line has been difficult to go back up. We do continue to see sales go up leading into January. That's often, I think, because people are maybe a little bit more health conscientious, so maybe you get that sort of cyclical bump, but we're not close to seeing the 2019 cyclical bump. We're not close to seeing the 2018 bump. We are exceeding the 2020 bump right before the pandemic, so maybe that's good. Maybe this is an indication that their inflection point is correct, that we are going potentially into that growth mode again. We'll see. The service is getting better and better. It's something I want to keep an eye on. I like that their margin keeps going up in terms of how they're able to produce revenue right now. We don't have a full earnings release from them yet, so we only have bits and pieces that we can puzzle together here. But they are indicating an increasing gross margin, which is good. And at the same time as their projections for revenue are going up, they're actually thinking they're going to spend less on sales and marketing, which is interesting to me, that their sales and marketing is going down, but they actually expect this increase in revenue. We'll see how that actually goes. Now, when researching 23andMe a little bit more, I've noticed that the package that I bought was the $99 package, which does for free update my geographic regions and my family tree and DNA relative finder. But I actually don't get all of the benefits that I could be getting if I had their membership. So this is how they're trying to monetize this package a little bit more. They're trying to essentially charge people about $30 a year so that you could get the latest and greatest reports on research. And really what 23andMe is doing here is, if we go back to their slide deck, is they're suggesting that, hey, our future revenue estimates assume that we're going to be able to get 100,000 people to sign up in 2021 for this $29 a year package. We think we're going to get 600,000 users between 2021 and 22, another 900K users, and another 1.3 million users over here between 23 and 24. These are estimates. We don't know that. So you're going into the SPAC, again, you're getting in really early, and we don't have all the actual proof in the pudding of, are they actually going to be able to convert people? Are people just going to pay 99 bucks one time, get their DNA, and they go, do I want to pay 30 bucks a year? I don't know. I could buy quite a few iced coffees from Starbucks for that, so I don't know. Then we get to the financial summary. So it makes sense that if they're going to charge a yearly fee, that their margin is going up. I always like to know why does a company think their margin is going to go up? And it really seems like once they get into this annual service, that's when they think their margin is going to go up. Now, what we're going to do here is we're going to zoom into this section down here. So this is revenue and gross margin. Revenue is right here. So this is revenue. This is gross margin, 58%. This is some of the data they give us. Then they say consumer and research services. They're going to spend $71 million on this. In the last slide for 2024, we found out that they're going to spend, right here, $85 million in 2024 on marketing. So what we can do is we can puzzle some of these pieces together. And we're going to go down just to this corner right here and go, okay, they're assuming they're going to have $400 million in revenue, 58% gross margin, and we already know they estimated on the other slide they'll have $85 million in marketing. Then they're going to have $71 million in other expenses, and that would lead them to, or consumer research expenses, that would lead them to being negative $78 million. That means somewhere, and they're not putting it on this list here, they're also spending another $150 million on other items, which in my guess could be administration, distribution, whatever. Somehow they're spending another $154 million. So this really puts a picture together for us that they're assuming in 2024 they're going to have $400 million in revenue with a 58% gross margin minus $85 million in marketing. That's what they told us on the other side. Minus $71 million in customer research. That's a number they gave us. Then they told us they'll be negative $178. So we're assuming $154 million is going to something else. A cool thing that I can do now is I can try to forecast. Let's say we take those same numbers and we try to make them profitable, okay? We make this company profitable. We assume they have $600 million in revenue. We take off the same 58% in margin. That brings us to $348 million of money left over. Minus, let's assume the same $85 million in marketing, the same $71 million that they spent over here in customer research, and the same $154 million in other expenses. We're just assuming everything from 2024 to 2025 is flat, but their revenue goes up by 50%, let's just say. That would leave them with about $38 million in revenue. This SPAC you're investing in only gets about 11%. So VGAC only gets about 11% of that. And it's worth 25 million shares. So 11% of 38 million. I know not a lot of numbers going on here. We're going to pull some of the bottom lines together here. 11% of $38 million. So 38 million, 1, 2, 3 times 11%. Leaves you with about $4.18 million in revenue to be split by 25 million shares, which means each share has about 16 cents of earnings in 2025 if they grow 50%, which means you are paying at $16 a share of this SPAC, you're paying about 100 times earnings, assuming that this company between 2024 and 2025 can grow 50%. That's assuming that we can delete all this now. Now we have all this that we kind of walked through. Let's draw some simple conclusions because I know sometimes this can be a little complicated to follow. So bottom lines are that assuming all of their assumptions here and projections are correct, that they can grow their subscription model like this, that they can grow margin like this, that they can grow their business by spending less money on marketing, and that they can grow 50% between 2024 and 2025, then maybe you are paying 100 times future earnings in 2025. Folks, for me, a little too speculative. Little too speculative. It's one thing if I say I'm going to spend 100 times earnings at Tesla because they're on the trajectory to actually produce these vehicles, and I know people are buying the vehicles, and I know they're having that margin. We're projecting that people are going to sign up for this subscription service. Look, don't get me wrong. I love 23andMe. I love the service. I think it's great. I think it's brilliant. I think they're going to find some amazing ways to make money in the future. 10 years from now, this company could be a phenomenal company to invest in. Do I want to put money into them now without having some more of that validation? Honestly, I'm probably going to have to wait a couple years to really get excited about 23andMe. These are just my first impressions. We'll see how my opinion changes over the next few quarters when they actually report earnings as a public company after they actually have their merger. We'll see. I think after the SPAC merger, it's always possible after a merger you see a little bit of a sell-off. For me to get an 11% stake, or even substantially less, obviously, than 11%, it's really 11%. 125 millionth of 11% as a one share stakeholder. For me to actually get here, start buying this company, I don't know. I think it's too premature. A lot of pro formas, a lot of excitement, a lot of money going into this company with a SPAC. This is a great opportunity for 23andMe. But for me as an investor to come bail this out, I shouldn't say bail this out. For me, it's a little bit too early. My thoughts, my 2 cents. Let me know what you think in the comments down below. What did I miss? What did I get right? Let me know. Thank you so much for watching. These are just my first impressions. As usual, this is not financial advice. This is just some dude with a RuneScape t-shirt babbling about 23andMe. So take it for what it's worth. Thanks so much for watching, and folks, we'll see you in the next video.